Let's start with the risk curve first of all. I think the issue about where you sit on the risk curve as a bank versus a debt fund is quite a significant point of importance. And the reason is how the capital is sourced by banks versus debt funds or alternative debt providers. And if you look at that, banks tend to source, other than their equity capital base, which is predominantly for regulatory and shareholder purposes, most of the money they lend is sourced in treasury markets. They borrow short, lend long. Being an ex-banker myself, and I used to do the treasury side, I used to run a short funding book against a long lending book. So what happens in a bank is they have very volatile capital on one side and very stable income-related investments on the other, or loans. In a debt provider, such as a fund or alternative source debt provider, they tend to have quite fixed long-term capital bases where the expectation of return is determined at the beginning of the life of that fund. And however the market moves, the manager of that fund has to be able to service the expectations of their investors. On the other side of that equation, you have the products they lend into, and if they're investment related, even if they manage to lend their capital initially at margins or implied margins which are acceptable to their investors, if they move out of the market, there's one thing you can be pretty well assured of, and that is the borrowers will refinance with cheaper sources of capital from the banks or other funds. So repayment will become a reality, which means that the debt funds, as they are constructed presently, closed-ended and on a fixed return basis for their investors, are always fighting the currently downward pressure of the market in terms of returns on lending. What that forces the debt funds to do, of course, is to move up the risk-return curve in order to find the kind of returns that are then compatible with their sources of finance or their equity. Now, that may not be a bad thing. Initially, a banker might turn around and say, that's no way we're going to be doing development loans. However, being in the alternative debt fund market might be another way of looking at how you allocate on a macro basis the different levels of risk in real estate to the sources of capital. And what that means is if you're a bank, you are probably less tolerant to higher risk investment or lending than you are if you're a debt fund provider. And providing the debt fund managers are completely open with their investors, then it is quite conceivable, and not necessarily a bad thing, that the risk-return matrix in a debt fund is probably going to be higher than it necessarily would be in a straight traditional lending bank. And we see that because the lending banks, for example here in Germany, are fund brief driven, which means they have a particular style of lending that they can engage in. Whilst debt funds, for example my own or many of my competitors in London, whether they're lending in London or across Europe, tend to be looking at higher risk return categories. So I think that's part of the answer to the question. I think the second part of that question is how do debt funds then compete with traditional sources of lending? I think we have to move away from a model which is dominated by closed-end funds. And if you can move to an open-end fund basis and at the same time move your return target from absolute to relative based around some kind of interest rate scenario, then you start to have something which looks more like the way in which banks fund and lend. So the longer term course or trajectory for the debt funds would be to consider open-end fund structures with relative return criteria. Because I think the closed-end model is only workable in markets where the returns are stable and where the ability of the managers to deploy can be safely predicted within their deployment period. And what we have seen over the last 12 months, going back to the question that Sasha answered, is and I said it at the beginning, a roller coaster. And you can look in any of the markets in Europe and the UK, and we have been from the peak of where that car is travelling, we're all the way down the curve, and that curve has been incredibly fast. If you like, to use a rather odd expression, most of the lending markets have taken speeding tickets on that deceleration coming down the yield curve in terms of returns. And now it's starting to pick up. And it's almost as if the roller coaster car has travelled to the top, dropped to the bottom, is now starting that climb. But we don't know yet if that climb is going to be a slow hump or another steep one. And that's probably the open question at the moment.